Welcome everyone, my name is Rajiv. I'm your local realtor in Surrey, and today I'm going to walk you through the fundamentals of evaluating a property from an investment point of view. We're going to go through terms like NOI, vacancy rates, DSCR, and many more. So stick around if you want to understand how to evaluate a property. So the first thing we're going to do is take a real example. And what do I mean by that? So let's assume you're looking at a condo complex that's got 10 units in it. And for simplicity's sake, let's assume that those 10 units are each generating $1,000 a month in rent. That means the total rent you're getting from this is 10 times 1,000 times 12, that is $120,000 a year. Now that number alone doesn't mean much. But if you take away stuff like operating expenses, management fees, and other small expenses from it, you're left with something called the NOI, or the net operating income. And that's the first term that we're going to talk about it. Now, what else is included in the net operating income? You've got your taxes as well. However, one important thing to remember is that you do not include your mortgage payments when you're calculating your NOI. So let's assume that all these expenses are costing you $40,000 a year. That means your net operating income for this property is $120,000 minus $40,000, that's $80,000. So that's the first term that we're going to talk about, which is NOI. And remember, your mortgage payments for this condo are not included in your NOI. So that's a very important thing to remember. The second thing that we need to worry about is something called vacancy rates. No property is going to have 100% occupancy. So let's assume that on average, 5% of your condos are vacant at any given time. That's your vacancy rate. Usually vacancy rates of 5% are pretty acceptable, but they can go up to 10% depending on where the condo is located, except with that 5% vacancy rate, your realistic income would be $120,000 minus 5%, or your adjusted gross income would be $114,000. Now, you don't use this in any calculation per se, but you need to keep this number at the back of your mind, because if the difference between your gross income and your adjusted gross income is very large, you might want to rework those numbers. But the most important number we're going to move into now is what you call the cap rate. So what is the cap rate? Now, we've already discussed the net operating income of this property, which was at $80,000 a year. And now if your seller is asking you for $1 million for this property, so that would come to 80,000 divided by $1 million, assuming you paid $1 million to buy this condo complex, into 100, which would come to 8%. Now, this is a pivotal number. If you ever pick up a brochure or a marketing material for any investment property, you would see the cap rate is usually mentioned very clearly. If not, that's usually the first thing your realtor is going to find out for you. What is the cap rate on this property? So in our example, the cap rate of the property is 8%. But there's a very important thing I had mentioned earlier. Now, if you remember, I had mentioned you don't take mortgage payments into any of these calculations. So where does that come in handy? Well, that comes in handy when you want to calculate something called the DSCR. So what does that stand for? It stands for Debt Service Coverage Ratio. What is that and why is it important? So this number is something you're going to use internally when you're going to try to get financing for this deal. And this is a number that the banks or the financing organization would also calculate along with you. So how do you calculate the DSCR? That's a great question. Let's dive right into it. So let's assume your mortgage payments were going to be $60,000 a year. Now, you know the net operating income of this property was already $80,000 a year. So your DSCR is 80,000 divided by 60,000, which comes to 1.33. That's a pretty good DSCR. Typically, banks would look at a 1.2 and above DSCR before they finance a deal or give you favorable financing. But what does this number basically mean? What this number means is a 1.33 DSCR basically means that you're making 33% more money than you need to cover your debt on this property. And that's an important number to keep in mind. You won't find this on any marketing brochures because this is something that is very specific and very internal to yourself, but it is something that would come in handy when you are getting finance. And there you have it. That's the basic math you'll go through every time you look into investing into a residential multifamily property. Follow me, Rajiv, for more videos and for more assistance in your journey as a residential investor. This is me signing out for now. Hope to catch you in the next one.